Good morning, everyone. Thank you for joining us for today's webinar. I'm Simran and I work with Tally Solutions for the Middle East region, and I will be your host for today. As you all know, the news of UAE Corporate Tax is one of the biggest news after VAT. And on the 9th of December, the Ministry of Finance officially announced that corporate tax on business profits will be applicable from 1st June 2023, and most businesses will become subject to the UAE Corporate Tax. We understand that you will be eager to know more about this compliance norm and its impact on your business. Just some ground rules before we get started to ensure a flawless experience for everyone. All the participants will remain on mute throughout the session to avoid any noise and disturbances. Please be informed that we are recording this session and that it will be available later. I apologize in advance for any network interruptions that may occur. However, we will try our best to make this experience seamless. I'm sure you all have a lot of questions during the discussion. Please type them in the question box of your Zoom control panel and we'll bring them up towards the end. Today, we have three eminent personalities with us who have got profound knowledge on this topic. And let me first invite and introduce our first speaker for the day. First, we have CA Chirag Gupta with us, who is a qualified CA, CS, CMA from India and partner with RNG Auditors. He is having experience of 15 years in audit, tax, and compliance. Chirag is registered as an insolvency practitioner and official liquidator with DIFC Free Zone and is a speaker at various forums. Over to you, Mr. Chirag, who will introduce us the corporate tax to us and the registration.
Thank you, Ms. Simran, for the kind introduction. It's our pleasure that being a Saturday morning, we have such a huge gathering, which itself speaks how relevant the topic is for all of us. So we are truly honored. So with this, I begin my presentation. So my presentation, I would be speaking about a simple introduction about the corporate tax and how we can register the company or ourselves in the corporate tax. So as we all know that UAE is introducing corporate tax from 1st of June 2023 as an international best practice as it moves from no tax to low tax jurisdiction. It doesn't want it to be called as a tax haven country. So here we are for corporate tax, which again would be on the profits of the company. It's very clear that individuals who are having salary income is not applicable on that. Moving on, the corporate tax rate is one of the lowest in the world, which is 9%. And if the profit is less than 375,000, it would be zero rated. There's one more good news for free zone person. If you are a qualifying free zone, then it would be 0% on qualifying income and 9% on non-qualifying income. Now we still are waiting on the definition of what is qualifying income. For the qualifying free zone, our speakers in the next round will be talking about the definition of a qualifying free zone. Okay. Now the tax return. Again, the tax return is a single tax return which you will file after the 9 months of end of the financial year. Again, the authorities have kept it very simple, unlike in other countries where we have to file advance tax or half yearly return or quarterly. No, there is single tax return, which again after the 9 months. So again, the authorities have given a lot of time so that the companies can finalize the books of accounts. Now let's see, depending upon the financial year, from what date the corporate tax is effective. So let's see, suppose if your financial year of the accounting year is July to June, then in that case, your corporate tax effective would be from 1st of July 2023. For instance, if your accounting year is Jan to December, which I assume is for mostly companies, then your corporate tax will start from 1st Jan 24. It will end by 31st December 24, and the deadline to file your return and submit the tax liability, if any, will be 30th of September 2025. So, as I mentioned, the authorities have given sufficient of time for the businesses to prepare themselves. In another example, if the accounting is April to March, then the effective date would be from 1st of April 2024. Moving on to the tax registration. Now, here are some of the information and documents that you have to keep in hand before you start the corporate tax registration. Now, I have bifurcated the requirements into two, which is legal person and natural person. So legal person, it can be a LLC or a private joint stock company. First and foremost, obviously, as we know that UAE is moving to paperless, hence the registration is again online. You might be already having a VAT registration. So we can use the same portal login. We don't have to create another login for corporate tax. Then another element that we have to decide is whether the company would like to go for a group or an individual registration. Now, let me first clarify that the VAT group will not be the same over here. The conditions are different. The conditions will be discussed by the speaker in the next one. Moving on, all the corporate documents like your trade license, your memorandum. Now, sometimes we see that when the company was formed maybe 10 years back, after that, there were a lot of amendments in the memorandum. So we need to keep a track of all the memorandum from the date of incorporation till date. Then the tax period. As we have seen in the previous slide, that depending upon the financial year, your tax liability depending upon the financial year, the return liability and the date differs. Hence, you have to make sure what is mentioned in the memorandum and articles of association, or how you are preparing the audit reports for the last couple of years, it should be the same. Many times, people say, let's change the tax period so we will have more time to submit. But the general anti-abuse law is already in place, so we cannot change now corporate tax period, and we follow the same period which is mentioned in your memorandum and articles of association. Then are the owners list and their details. The details, we have to make sure we have the passport copy, visa copy, local branch. Now, authorities have clarified that we don't have to register separately the branches, because branch is just an extension of the main head office. So one single registration for the entire group, which is the main parent company and their local branches, is sufficient. Then the contact details, the address, mobile number, landline number, email ID of the authorized person to whom the tax authorities can contact in case of any discrepancy. And last is the authorized signatory. Suppose you want to appoint your manager, your finance manager or CFO as the authorized signatory, then you can also appoint them, but there should be proper justification for that. Moving on to the requirements for an individual or a sole establishment. Now you might argue, Chirag, you just mentioned in the starting that on individual there is no corporate tax. Then why individual has to register? So individual has to register in case if he or she is having any business income. And for sole establishment, because in sole establishment, the individual shareholders or the owners are responsible, hence it will come under individual. However, here as well, authorities have given a right to choose for the sole establishment. If they want, they can register themselves under legal person. So let's see what are the requirements in case of individual. First and foremost, the MRI tax portal login. If we don't have, we can create a login. Then the KYC document of the individual, which is the passport, Emirates ID copy. The tax period, as we discussed already, the tax period, why it is important. So accordingly, we have to choose. And the last is contact details, the same like email ID, telephone number, address, to whom the authorities can contact in case they want to. Now, let's discuss about the registration, how the form looks. So when you log into the MRI tax portal, this is the screen appears, and you can see there is one box called corporate tax registration in the right hand corner, which I have also highlighted in red. So over here, when you log in, you can see this option is already appearing. You can click on this and then the registration process will start. Before we go to the form, the first and foremost question it asks, what type of entity, whether you are legal person or natural person. So if you see, in legal person, there are so many categories, and the natural person as well. So as I mentioned earlier, on the requirement side, before you start the process, you have to make sure under what category you are classifying yourself, because based on this, the lot of questions may change. Presently, the corporate tax registration is only started for legal person and under that for LLC and public joint stock company. For the other subtypes, authorities will soon start the registration. Now, when we start the form, this is the form how it looks like. As you can see, there are total 5 stages or 5 pages, which I have highlighted in red box. Again, another important thing is there's an option called Save as Draft. Suppose you started filling the form, but in case suppose you got a call or you're winding up the day, so you can always save as draft and then again come back and fill the rest of the form. So you don't have to re-enter the data which you have already entered. Moving on, once you submit the form, then you will get this acknowledgement that the form has been submitted with the reference number, and authorities, if they found okay, they will allot you the CT TRN, which is corporate tax TRN number. And in case of any issues, they will come back to you to resolve. So this is the journey for the tax registration. Now it may seem easy to you over here, but when we start, there are a lot of complications or the requirements arises. Like generally talking about the corporate tax law itself is of 60 pages, but the manual which the authorities issued for the corporate tax is of 40 pages. So you can itself understand how the process can be tricky once you start it. Now, what are the key points that we have to consider when you are starting the tax registration? First is deadline. Is there any deadline? No. Right now, there is no such deadline for the registration, but before your due date, you have to register. Threshold, unlike VAT, there is no such threshold. Even if you are a free zone company, even you have loss, zero rated, 9% doesn't matter. All the UAE related companies has to register, number one. Number two, even if you are a branch of foreign company operating in the UAE, they have to also get it registered. Then business activity. One of the important elements once we do the registration is the form asks you for the what is a business activity, primary and secondary. So you have to carefully select based on the menu, what is the business activity best suited to you. Then is owners. As we discussed initially, we have to maintain and provide them the owner's passport and MSID copy. So the form only asks for or is mandatory for owners who are holding 25% or more shareholding. For less than 25%, it is optional. Local branches. Over here also there are a lot of disconnect because when we talk to the client, they say, okay, I have one company in Dubai and I have branches in Dubai, branches in Sharjah, Abu Dhabi, Ras Al Khaimah. But when we see the trade license, it is separate legal entity and not as a branch of Dubai. So in this case, we have to register all separately and not as a branch. So we have to always see the documents, what the documents say, whether it is really a branch or it's a separate legal entity. Address. Sometimes we see that in the form or the client requests that you are my auditor, you are my consultant, you mention your address, but no. We have to mention the principal place of address from where the business is being conducted. Or if we say that owners have multiple addresses, so we mention the principal address of the company. Tax group. Now, tax group is again a very important element which the authorities have given. We can do tax planning, but again, as per the requirements and the regulations under the law. And again, I would like to mention that this tax group under corporate tax is entirely different from VAT. So we cannot generalize that my VAT group will be same under tax because the requirements for both are different. This is from my side. Thank you very much. Over to you, Simran.
Thank you, Mr. Chirag, for such wonderful insights. Next, let me introduce CA Harikishan Rankawat, who is a fellow chartered accountant at FCA from India and a certified public accountant from USA. He is engaged in audit, tax practice, compliance, and advisory services in the GCC. He has over 26 years of diversified experience in various roles in publicly listed companies, local family conglomerates, and multinational companies in India, UAE, and Kuwait. He's currently working as partner and CEO of RNG Auditors. Mr. Rankawat is also currently serving as the Vice Chairman of the Institute of Chartered Accountants of India, Dubai chapter. And he's also a trustee of the Rajasthan Business and Professional Group in Dubai. Mr. Rankawat is a regular speaker at various forums on tax and finance related topics, and he has written various articles in local newspapers and was also interviewed many times on the radio. He has worked as a faculty for UAE VAT and corporate tax law. Today, Mr. Harikishan will give us insights on residential status, income, and deductible expenditures. Over to you, CA Harikishan.
Hi, can you hear me now?
Yes, we can hear you.
Yes.
Yeah, good morning, everyone. I think Chirag has given a fairly detailed, understanding on how to register for corporate tax. And I think he has already registered one of the company yesterday, and it went very smoothly. One thing which we have to keep in mind, which Chirag has already spoken, but I want to reiterate that fact that all the companies, whether their income is zero or they are running into losses or their income is more than 375,000, everyone has to register for the corporate tax. That is very, very important, because if you are having the losses, then you know that you can always carry forward your losses for indefinite period. And in the case of a startup as well, where in the beginning generally you have the losses, so it is better to register in your own interest. Now, another point, which general anti-abuse rule, that has already been kicked in. So if you are changing anything, whether it is your financial year or you want to change your place from free zone to mainland or mainland to free zone in order to gain any tax advantage or any other change in the enterprise structure, please do it with the help of consultant, because whatever you are doing, it has to be justified and it has to be rationalized before you do any changes. Because FTA might, they can roll back or recharacterize whatever changes you are making from now till the corporate tax implementation date in order to gain any undue tax advantage. Now, I'll go through my presentation. As you see, that basis of taxation, this is very important. First, we have to understand, whether our residential status, whether it is resident or non-resident, or whether we are in free zone or our income is exempt. So I'll go one by one. See, basis of taxation here, as I mentioned you, that you can divide into parts, resident and non-resident. So in case of resident, all your worldwide income will be taxable apart from your UAE sourced income. And in case of non-resident, only UAE sourced income will be taxable in UAE. Now, in case of resident person, there are three categories. Legal person. Legal person means whichever companies you have incorporated or registered either in the free zone or in the mainland. So if it is in the free zone, if it is in the mainland, then 9% tax will be applicable. And if it is in the free zone, then 0% tax will be applicable. If there is any foreign company and they are having their permanent establishment in UAE, then 9% tax rate will be applicable. We can take one example. In case of foreign company, suppose I am the shareholder director of the US foreign company and I am based in UAE. So I am staying here in one of the residence based in Business Bay, and I am doing all the work, taking all the strategic decisions, day-to-day routine decisions for that foreign company while sitting in Dubai. So I am having, or that non-resident company is having a permanent establishment in UAE. So tax will be applicable at the rate of 9%. If there is any natural person like an individual person like you and me, or any unincorporated partnership in UAE, unincorporated partnership is the one which is like not incorporated with the free zone authorities or with the mainland authorities like DD. So like maybe an individual like me and Chirag can have an unincorporated partnership, or maybe two companies, they might enter into a joint venture and they can have that unincorporated partnership. And in case of unincorporated partnership, you have the two options. Either you can register and file your return based on the like as an unincorporated partnership, or you can opt for, whereby individuals or the companies under that unincorporated partnership can file their return individually as well. And in case of natural person, one thing we have to keep in mind that if any income is derived from outside UAE by the natural person, then it will be taxable only in the UAE when it relates to the business activities conducted in the UAE. That point you have to take care. Otherwise, in case of resident, all the worldwide income will be taxable, whether it is UAE sourced income or overseas income. And in case of non-resident, only UAE sourced income will be taxable. So non-resident is the one who is not a resident. And in case of resident companies, I mean, as you guys are aware, how will we prove that we are a resident? I mean, you can always apply for TRC, tax residency certificate, whereby you need to submit your audited financial statement. And you know that audited financial statements are generally prepared for 1 year. You can submit your bank statement, as well as you can submit your office ijari as well. So based on that, FTA will issue a tax residency certificate, and then your resident status is clear. And same way you can do it for individuals as well. But yes, in case of individuals, generally they have to stay here in this country for 182 days. Or now they have changed. I mean, if you even stay here for 90 days, then also you are being considered as a resident and you can apply for tax residency certificate. But then again, it depends on the treaties between the various countries. That treaty will also play a vital role in that case. Non-resident person, as I mentioned, that if they are having any P in the UAE, then UAE sourced income will be taxable at the rate of 9%. And if that non-resident person is not having any PE, permanent establishment, then in that case, 0% withholding tax has to be deducted by the UAE company while remitting any funds to the non-resident company. So as of now, it is 0% withholding tax, but in future they might increase this withholding tax. Now nexus, if you have any nexus in the UAE, then it will be 9%. As of now, nexus has not been defined in the UAE corporate tax law, but we assume that it will be clarified by the cabinet decision in the coming time. Now, free zone persons, there are actually 4 conditions which you have to satisfy in order to become the free zone person or qualifying free zone person. So first of all, you have to maintain the adequate substance in the UAE. Adequate substance, we can take the same definition which is there in the economic substance regulation, that you need to have an office in the country, you need to have employees in the country, and you need to incur operating expenditure as well in order to create the economic substance in the country. Then number 2, you have to derive only qualifying income. Now, qualifying income is still it has not been clarified in the UAE corporate law, but it will be clarified very soon in the cabinet decision. Number 3, as a free zone person, you have not elected for corporate tax at the rate of 9%. If you want to don't want to be charged at 0%, you have always an option for election. And if you are not selected for that option, then you will be qualifying free zone person and will be eligible for 0% corporate tax. Very important thing, you have to comply with transfer pricing rules and all the documentation requirement, which our next speaker Atul will be elaborating it further if the time permits. So this is the definition of the qualifying free zone person. These 4 conditions you have to satisfy, and the 5th one it is mandatory as per the UAE corporate tax law that all the qualifying free zone persons have to have their audited financial statement. Otherwise, they will not be considered as a qualifying free zone person. So audit is mandatory for the free zone companies, but for the mainland companies, they didn't mention anything about the mandatory audit practice. Okay. Next one. Now, these are the exempt persons. Actually, you can have a look at it. These first four, like government entity, government controlled entity, a person who is engaged in extractive business or non-extractive business. So these four entities by default automatically are exempt persons. If they are doing their mainstream business, well and good, they are exempt. But if they are doing any other business, then that business will be subject to tax, and they have to prepare the separate financial statements for that other businesses. Now, public pension or private pension fund, qualifying investment fund, and any other entity which is owned and controlled by exempt person, they have to submit an application to authority for exemption if they want to be exempted. If they don't apply, then they will be taxable. So here it was automatic exemption, but here you have to submit the application for exemption. And the last one is qualifying public benefit entity. Qualifying public benefit entity is the one which is generally working for the social benefit or any other religious, charitable, scientific, or any other causes, I mean, which is mentioned here. And the qualifying public entity will be exempt, I think, when cabinet decision will be issued very soon, and they will clarify it, which are the qualifying public benefit entities who are exempted. So we have to wait and watch for that. Now, income, we were talking again and again about UAE sourced income and exempt income. So UAE sourced income, we have to understand that when any income will be considered as a UAE sourced income, there are three criteria actually. If the income is earned from the UAE resident person, then this is very clear cut. Number two, if the income is earned from UAE PE of a foreign company, permanent establishment, I already explained, I gave you an example, whereby if you are having any, I mean, if you are working from home even, and you are representing that foreign company, then P is here. If you are having a temporary office or factory or any real estate, and you are working from here, then it will be considered as PE in the UAE. And all the income which you are sourcing in the UAE will be UAE sourced income. And the number third one is if you are deriving any income from activities or contracts performed in the UAE, or you have any assets in the UAE, or the rights used for economic purposes in the UAE. Rights means maybe patents, copyrights, those kind of rights. If you are generating any income in the UAE, then it will be considered as UAE sourced income. Now, exempt income, there are 5 types of incomes which are exempt. Number one, dividend and other profit I have received from a resident juridical person. From a domestic company, if you are receiving any dividend and other profit, that will be 100% exempt. Any dividend and other profit, if you are receiving from a participating interest in a foreign juridical person, then that will be also exempt. Participating interest, I will explain you the definition later on. Number third one, income of a foreign establishment, if the foreign company has opted or foreign tax rate is at least 9%, then in the foreign they are already paying 9%. So their income, whatever they are generating here locally, that will be exempt income because they can't pay taxes twice. And the fourth one is income derived by a non-resident person from operating aircraft or ships in international transportation. That will be an exempt income. And the fifth one is any other income from a participating interest, like capital gain or from a participating interest. Let's understand the definition of the participating interest. A participation is the foreign juridical person in which the UAE shareholder company owns 5% or greater ownership interest, which is held, or you have the intention to hold it for the next 12 months, and such foreign juridical person is subject to minimum 9% corporate tax in their respective country. So that will be considered as participating interest. And in that case, it will be exempt income. I already discussed about the 5 exempt incomes. Now we can have a look at Chapter 9 deductions. In Chapter 9 deductions, there are 6 articles from Article 28 till Article 33. And they have defined like Article 28 is deductible expenditures. Then from Article 29, 30 and 31, these are 3 articles are for interest expenditures, and Article 32 is for entertainment expenditure, and Article 33 is for non-deductible expenditure. Today, because the time constraint, I will go through the from Article 28 till Article 32 only, and Article 33 maybe we can take in the next webinar. Let's understand now Article 28, deductible expenditures. See, any expenditure will be deductible only when this is incurred for wholly and exclusively for the business. And it should not be incurred. Any expenditure should not be incurred for personal purposes. And if there is any income or expenditure which is being incurred for capital nature, then that will not be allowed as a deductible expenditure. And like if it is capital expenditure, then you have to capitalize it, and then you have to depreciate it, and that depreciation will be allowed as a deductible expenditure. But then again, we have to wait and watch for the cabinet decision. I mean, if there is any different depreciation rates coming up for the income tax purpose. So let's wait and watch. Now let's look at the expenditure which is incurred for the business and other purposes. So this expenditure where it is mixed like business and personal, then what you can do, whatever identifiable portion is there, that will be deductible expenditure. Clearly, there is no doubt about it. But for the unidentifiable expenditure, now you have to actually calculate or allocate based on some cost driver, and you have to identify from that unidentifiable expenditure the expenditure which is pertaining to business. That will be deductible, and rest of the portion will be undeductible. And non-deductible expenditures, as I mentioned you, if it is not for business, and if any expenditure which is incurred for the exempt income, if there is any losses which is not related to business, or any other expenditure which may be notified in the cabinet decision, that will be non-deductible expenditures. Now let's have a few examples. Whether accrued salary and wages in the accounts are permitted as a corporate tax deduction. It will be allowed because it is part of the salaries. And one thing you have to ensure that these salaries and wages, maybe Federal Tax Authority might ask you to submit your, that statement, which is generally you are getting while paying the salary through wage protection system through WPS. So that will be one of the proof that you have paid your salaries. And I further extend this example. If the above amount is not paid to the employee within a reasonable period of the year end, then whether accrued salaries and wages would be allowed as a deduction? No, because if you are not paying and you don't have the intention to pay, then and if you are not paid within a reasonable period, then that will be disallowed. So as I mentioned you, ultimately it will be verified with your WPS statement that whether you have paid the salaries on time or not. Now, example 2, if you look at it, I mean, whatever expenditure you are incurring on the repairing the assets which are used specifically for the business, such as redecorating the office or fixing a broken machine, whether this repairing expenditure will be allowed as deduction. Yes, if it is for the business, then it will be allowed. But if there is major enhancement, then again you have to capitalize and depreciate it, and that depreciation will be allowed as a deduction. Example 3, if a debt or receivable which is no longer recoverable, then whether this bad debt will be allowed as a deduction. as you guys are aware that in the companies generally there is a AR policy and all the bad debts provisioning policy is there, and generally most of the companies are creating general provision as well as a specific provision. So in case of general provision, I mean that will not be allowed as a deduction. But if there is any specific provision, like you sold to a particular ABC company and that company is not paying, maybe within 6 months or within 12 months, then you are writing off that bad debts. That bad debts will be allowed as a deduction. So yes, it will be allowed as long as it is a specific customer debt. Now, interest expenditures. Interest expenditure will be deductible in the period when incurred, but there are two types of limitations they have put it. Number one, Article number 30, General Interest Deduction Limitation Rule, and Article 31, Specific Interest Deduction Limitation Rule. So in the next slide, we will understand detail. Let's understand General Interest Deduction Limitation Rule. This is actually, first of all, there are 4 steps. So you have to calculate. Number 1 step is net interest expenditure. You have to calculate the net interest expenditure. Net interest expenditure is very simple to calculate. You can deduct interest income from your interest expenditure, then you will arrive at net interest expenditure. And you can add, if there is any brought forward net interest expenditure, which was not able, you were not able to set off against your EBITDA, then that also you can add here. And that will be allowed for the next 10 years. You can carry forward the net interest expenditure, which is not, which you couldn't recover from the current year EBITDA. And the net interest expenditure, the cap, the limit is up to 30% of EBITDA, which is EBITDA, as you guys are aware, earning before interest, tax, depreciation, and amortization. So you have to calculate 30% of EBITDA, but from that EBITDA, please exclude exempt income. After excluding, you calculate 30% of EBITDA, and that will be your maximum cap, which will be allowed. So, and whatever is disallowed net interest expenditure, that you can carry forward and deduct in the subsequent 10 years in the same order. So generally, you will definitely, because the time limit is there 10 years. So always you have to use FIFO method, first in, first out. And these provisions like 1, 2, 3, these provisions are not applicable on bank, insurance provider, and natural person, individual persons. These limits are not applicable. It means for them, it will be allowed fully. There is no limit on that. Now I've taken an example. How do you calculate net interest expenditure? As I mentioned you, interest expenditure 250,000. Then you can reduce your income, interest income 50,000, and then you can add brought forward net interest expenditure, and then you arrive at 350,000 net interest expenditure. Then number 2 step is you have to look at the EBITDA, which is coming as per the financial statement, 800,000. Then you have to reduce the exempt income, dividend income from UAE company. As I mentioned you, from the domestic company, dividend income is exempt. You reduce it. Then dividend income from US company, where you have the participation interest more than 5%, then it will be exempt. So we reduce that 100,000 as well. Then you arrive at EBITDA excluding exempt income 600,000. And then you need to calculate 30% of this adjusted EBITDA, which is 180,000, 600,000 into 30%, 180,000. So this is the maximum NIE, net interest expenditure, which will be allowed to set off against the current year EBITDA. And remaining net interest expenditure, 170,000, that I have reduced from this 350,000 minus 180,000. Then you arrive at 170,000. You can carry forward 170,000 net interest expenditure for the next 10 years, and you can claim in future against the net interest expenditure. Now, Article 31, which is specific interest deduction limitation rule. Here, this is particularly for the related party loan. If you are paying any interest expenditure on the related party loan, then it will be disallowed for the following transactions with the related party, whether it is dividend or reduction or return of share capital, or for capital contribution, or you are acquiring an ownership interest in a person who is or becomes a related party. So that will be disallowed. But in the clause 2, they have given that if the clause 1, it will not apply in case if as a taxable person you can demonstrate that the main purpose of obtaining the loan and carrying out the transaction referred under clause 1 was not to gain a corporate tax advantage. And then clause 3, they have mentioned very clearly that corporate tax advantage shall not be deemed to arise where the related party is already subject to corporate tax at the rate of 9% or greater than 9% on the interest in a foreign jurisdiction. Then that interest will be allowed because you have already paid taxes on that interest in the foreign jurisdiction. Now I've taken an example quickly. I'll go through. Shareholder of ABC Limited UAE has taken a loan from his brother based in Bahrain to pay himself a 10% dividend. Whether this interest will be allowed as a deduction, because Bahrain is again a tax-free zone. I mean, they don't have any taxes as of now. So you are getting the loan from Bahrain because it is tax-free zone. So answer is no, it will not be allowed, and you cannot claim this interest on this loan which you have received from your brother from Bahrain. Now let's flip this example. If you have taken this loan from USA from your brother, and USA is already USA, you know that tax is already 20-25% on the individuals as well, depending on their income levels. So in that case, they have already paid the taxes on that. So this will be allowed. This interest on loan taken from the US brother will be allowed because he has already paid the taxes in US. Now let's go through the entertainment expenditure. Entertainment expenditure will be allowed maximum up to 50% of the actual entertainment expenditure, amusement expenditure, or any recreation expenditure incurred during a tax period. Now clause 2, they mention very clearly, clause 1 applies to entertainment expenditure incurred for customers, suppliers, shareholders, and other business partners. If you look at it here, they didn't mention employees, but I assume that employees are covered under other business partners. This is what I'm assuming, but yes, we have to wait and watch. I mean, for the further clarification in the cabinet decision, if they clarify whether employees are covered under other business partners. But as of now, I assume that it is covered. And in the clause 2, they mentioned further very clearly that expenditure should be incurred for meals, accommodation, transportation, admission fees, facilities and equipment, and any other expenditure which will be specified by the minister by way of cabinet decision. Now let's take a few examples. If you are having a meal with a client where work is discussed, then 50% will be allowed as deduction. If you are having meals and entertainment as part of the employee's compensation or as part of the labor's contract in the UAE, then that will be allowed 100% because that is not part of the entertainment expenditure. That is part of your salary or compensation or your wages. So that will be allowed 100%. Whatever meals or perks you are getting as part of the salary. Then employee meals at a conference, that will be allowed 50%. Employee meals while traveling, 50%. Food for a board meeting, 50%. Then dinner provided for employees working late. In the finance, sometime we are working late for the audit purpose or for the month-end closing or for VAT purpose, that will be allowed as a reduction 50%. Then if you are entertaining any clients, like you have given the concert tickets or for the golf games or something, or for any other concert, you have given him the ticket and he is going alone to enjoy that concert, then that will not be allowed because employees are not accompanying the client. So 0% will be allowed. I mean, if you are accompanying the client, then it will be allowed 50% as part of the entertainment expenditure. I have taken, a few legal cases, and based on that, I put it here. But yes, we have to wait and watch. I mean, maybe in the cabinet decision, they might clarify it further. Now, non-deductible expenditure, friends, as I mentioned to you that I will take it in the next slide, next webinar, but I can give you a highlight that whatever externally, if you are giving anything like donation, grants or gifts or any fines and penalties, other than any, yes, compensation for damages or breach of contract, if you are paying anything, then that will be allowed. But fines and penalties are not allowed. Bribes or other illicit payments will not be allowed. Now, internally, as an owner, if you are withdrawing anything like dividend, profit, or benefit, or any amount which you are withdrawn from the business by a natural person or a partner, that will also be disallowed. And any government takeaways like corporate tax, recoverable VAT input, yes, if there is any irrecoverable VAT input, then you can claim as deductible expenditure, because that irrecoverable VAT input will be part of your expenditure, which will be allowed anyway, if it is incurred wholly and exclusively for the business. And any other tax or other expenditure which may be specified by the minister in the cabinet decision, that will also be disallowed. I think I have done it from my side. And one more thing you have to keep in mind, that as per the Companies Law 2021, Article 171, they have mentioned very clearly that directors' remuneration for the public joint stock companies is allowed up to maximum up to 10% of the net profit, if the company is running into adequate profit. But if the company is not having adequate profit, or if the company is running into losses, then the maximum director's remuneration, including their fees, will be allowed up to 200,000 dirhams. So sometimes, in order to arrive at deductible or non-deductible expenditure, you might have to look at the labor laws or companies law, UAE companies law, which might be pertinent to note. I think I have done from my side. Thank you very much. Simran, over to you.
Thank you so much, CA Harikishan. Now let me introduce our next personality that we have with us, CA Atul Gupta, who is a staunch leader that has risen to highest echelon of accounting profession to acquire position of the president of the Institute of Chartered Accountants of India for the year 2020 to 2021, the second largest accounting body in the world after being its vice president in the year 2019 to 2020. He has served the accountancy profession for more than 2 decades and is widely respected for his strong organizational skills and deep insight in the affairs of the profession. He has been the first chairman of the Accounting and Finance Services Sectional Committee constituted by the Bureau of Indian Standards. He has also been the member of the Government Accounting Standards Advisory Body, Insurance Regulatory and Development Authority, and SEBI's Primary Market Advisory Committee. On the international front, he's on the board of the International Federation of Accountants, XBRL International, and he earlier has been the chairman of the Committee on Education, Training, and CPD of SAFA, board member of SAFA, IIRC, PFC Committee of CAPA. Being thoroughly conversant with the professional concerns and demands of his time, CA Gupta has authored many relevant books and has published numerous articles in leading newspapers, magazines, and professional newsletters. And he has delivered more than 1,600 seminars and conferences. Today, CA Atul will talk about tax laws, tax group, and transfer pricing under the UAE Corporate Tax. Over to you, CA Atul.
Thanks, Simran. And at the outset, I'm thankful to the RNG Auditors, Haribhai and Chirag ji and the team Taxo for giving me this opportunity that we are discussing today about the corporate tax, which is now getting implemented in the UAE from the 1st of July 2023. Now, my dear friends, when we are discussing about this 1st of June 2023, my dear friends, when we are discussing about the corporate tax, you will agree with me that though there are only 70 odd articles are there which are carrying the entire gamut of the corporate tax, but if we wish to understand the 360-degree view, which my two other colleagues try to demonstrate to all of you, I just prepared this slide for the benefit of my colleagues, that the overall holistic view of the corporate tax will carry these 6 or 7 pillars. First of all, we all need to learn what is all taxability around that. Okay, which activity will be subject to corporate tax and which activity will not be. And then we will be discussing about the the general rules for the determining the taxable income, which very well touched upon by the Haribhai just now, along with the deductible expenditure. And then Chiragji mentioned about the registration return. And finally, we need to learn the transitional provision. So these are the basic aspects of the corporate tax which we need to learn. And then, my dear friends, there will be the specific instances, like there are the exempt persons, there are the exempt business entities are getting exempted, some incomes are exempted. And then we have a small business relief as well, apart from the benefit available for the participation exemption, which just Hariji mentioned that if that is more than 5%, then you are not supposed to pay the corporate tax on the same. There are the business restructuring in case of a merger acquisitions, what kind of a reliefs are there. You are aware about the slump sale, which will be taken care through the business restructuring part. My dear friend, then we have the taxable person, the state source income, the tax activity on which the corporate tax will be applicable, even if you are not a resident having a residential status. My dear friends, we need to learn specifically aspect related to the permanent establishment, related person, arm's length principle, and the various records to be maintained, because these are the aspects when I'm talking about the transfer of pricing issues, when you will have the transaction between the two business person, whether locally or at the one at the national level and but at the foreign jurisdiction, that how whether the income derived are being properly accounted for or not. So what are the various transfer pricing principles are there, which principle will be applicable, what kind of a records to be maintained. That is also very important for all of us to learn and implement in the due course of time. My dear friends, in the corporate tax of the UAE, there are the specific aspects related to the unincorporated partnership, that if you are not following, then how the individuals will be liable to pay the corporate tax rather than the partnership, then the family foundation, and specifically the tax group, which I am going to discuss, and vis-a-vis the qualifying group. Finally, as you are aware about the income tax of the any country, including India, the provision related to set off and carry forward of tax losses, which will be my first topic to be discussed today. The withholding tax, normally called as TDS, the foreign tax credit, if you are paying outside a foreign territory, then how you can claim the credit of the same, and finally, if any refund is there. And last but not the least, that is very, very important, the OECD related aspect about the GAAR, that is the Journal Anti-Abuse Rules. So my dear friend, this is the entire, I am trying to give you the bird's eye view of the entire corporate tax, and I try to classify them in such a way that we will be able to take one by one. So what I will suggest to Haribhai that in the next coming sessions, we need to take one slab at one limb of the entire discussion at one go, so that we will be able to give so practically in the 7 sessions, we will be able to complete the 7 different aspects of the corporate tax, which will make a more simpler understanding to our colleagues as compared to that, okay, we are discussing in different parts of the things. Now, my dear friends, as Haribhai already covered the few aspects related to the Hari and Chiragji discussed about the income vis-a-vis deductible expenditure, I will start my deliberation from the set off and carry forward of tax losses, and then I will move to the tax group. And finally, if the time permits, I will be discussing about the transfer pricing issue as well. I'm aware that there is a shortage of time. Already we are, we have touched upon around 55 minutes we have completed. So maybe that I will be able to cover. But the important aspect which Simran and other all colleagues will agree, that we will have to have the illustrations, examples to clarify the things. We have to have a deep dive as compared to we are covering many things in a single activity. Now, my dear friends, if I give you about the set off and carry forward of losses, or I will say that the set off of losses not only within the organization but outside the organization as well. So I have the very simple diagram prepared for the benefit of my colleagues, and I believe that it will help you to clarify the things in a more lucid way. Now, my dear friend, let us assume that I have a carry forward losses of 500,000 AED in the previous year. Now, previous year, as we will be discussing, that the previous year doesn't mean that the year which is the, say for example, 22-23. It's not a previous year. The previous year means the year after obtaining the registration, and once you become the taxable under the corporate tax of the UAE. Meaning thereby, if your tax period is from the 1st of July 2023, so the first tax period, the first previous year will be from 1st of July 2023 to 30th of June 2024. Meaning thereby that once you have taken the registration, only then only the previous year or the current year will be relevant. It will not be the the year prior to the taking the registration or the corporate tax become applicable. So let us assume that Mr. A is there having a loss of 500,000 AED in the previous year, that is 23-24. Now, first of all, we need to get the clarification that when we are talking about this 500,000 AED, that should not have the loss from following three activities. Number one, the pre-corporate tax losses, meaning thereby, if you have a loss in 21-22 or 22-23, then that amount will not be added into this particular loss. That will not be treated as a eligible loss for the set-off or the carry forward purpose. Number two, that the pre-registration tax loss, say for example, you are supposed to take the registration, but you have not taken the registration or you are not liable to take the registration. Say for example, you first took the registration in 2024. Then the pre-registration tax losses will also be not allowed to accumulate and carry forward in our future income. And number three, that in case your activities are the exempt activity. So say for example, I am doing in a business of a extractive business, which is there under the article 6.7. That okay, if I am doing that, meaning thereby, as mentioned by Haribhai, that income is a exempt income. So in case you have an exempt income, exempt activity, and from that activity you have a loss. So in that case also, that amount will not be also added into this 500,000. So meaning thereby, the 500,000 is a loss related to the activity which otherwise is a business activity and a taxable activity, and then you have a loss because of certain one or the other reason. After that, now what will happen that in, say for example, in the previous year you have a loss of 500,000, and in the next year you have an income of 400,000. Now what the law is saying, that the article 37 says that you can adjust this 500,000 from with the next year income, but with a cap of maximum 75%. Meaning thereby that the out of this 400,000, that's 400,000, 75% of the 400,000 is the maximum amount which you can adjust in a single financial year. Meaning thereby the 300,000 you can adjust out of this 500,000 loss, and the rest of the loss you have to carry forward for the next financial year, and then you can also adjust. Number one. Number two, that you may have a question. The viewers may have a question that okay, what will happen is that if I will adjust only 200,000 this year and the rest I will adjust in the next coming years? The answer is no. As given under the section 37 subsection 4, that the amount has to be adjusted the maximum. So it should not be that okay, that I will say okay, I will adjust 50% this year and 50% next year. The answer is no. You have to adjust the 75% maximum to the 75%, but at the same time the amount which is available to you, meaning thereby that you must be adjusted with the current income first. So up to which amount you can adjust? You can adjust up to 300,000. Meaning thereby you have to adjust up to 300,000. You have to adjust the 300,000 with this current financial year income itself. Now, my dear friend, then the rest of the 200,000 will be adjusted in the next years of that particular person. But with again a rider that the activity, the ownership or the activity or the asset of that business should remain as is. It should not be a case that okay, the ownership is getting changed. So if the A LLC is there, and wherein the ownership is getting changed from Mr. X to Mr. Y, in that case, this adjustment of the carry forward of the losses will not be allowed. Minimum 50% ownership will remain Mr. X with Mr. X only. Then only this adjustment will be available. Similarly, the activity and similarly the asset. there is only one exception, that in case of a listed entity, because in the listed entity, because the shares are getting listed, and there may be a situation that somebody will bought out the shares from the stock exchange. In that case, only this 50% condition is not applicable. So now, my dear friend, I just wish to take you on the next slide, where we are discussing about the clubbing. So this was about the setup of losses, which I believe that you must have got clarification from this diagram. Now, my dear friend, coming to the next one, before I go to the relevant provisions, that I will read out the provisions for the benefit of my viewers. The another provision which is related to this set of or the clubbing of losses, that is the transfer of the tax loss. So, but the transfer of tax loss means the clubbing of the provision with the another entity. So now, my dear friend, Article 38, which deals with this clubbing or the transfer of the tax losses, says that in case there is a one entity called X LLC and there is another entity called Y LLC. Now, my dear friend, they are saying that in case there is a loss of the X LLC, then that loss can be transferred to the Y LLC as well. But there are the few conditions for the same. Number one, that both should be the juridical person, meaning thereby there should be a legal entity. Both are the legal entities. Number two, that both should be registered with the UAE authorities. Number three, that directly or indirectly, there should be a holding of 75%, common holding of a 75%, meaning thereby, say for example, Mr. A is there. There are the two entities, X LLC and the Y LLC. And if there is a situation that the A is holding both, the ownership, having the ownership of on the X as well and on the Y as well for more than 75%, then only the X and Y can club their losses together, and then they will be able to adjust accordingly. There are two more aspects which is very, very important between the X and Y, that X and Y should not be falling under the free zone, or any one of them should not be rendering the exempted activity. So it is very, very important that both are dealing with they are in the mainland area, they are not the free zone areas, and both are dealing with the business which is subject to the corporate tax otherwise. And finally, both should have the same financial year. It should not be a case that, as the Chirag mentioned, that you may have a different financial year from July to June or January to December. Both should have the same financial year and following the same accounting standard. Then only this adjustment or the clubbing of the losses will be allowed. Now, my dear friend, though it will be very, I will not feel that, okay, that let me read the law for the benefit of all of you, because it will be a boring kind of a situation for all of you. So I try to prepare a diagram for the benefit of my colleagues, but very quickly, if you will go with the Article 37 sub clause 2, which talks about this 75%, that okay, that the maximum amount which you can adjust for the subsequent tax period is 75%. You can't say, for example, you want to adjust the 100%, that will not be allowed. Now, my dear friend, further to that, the section 37, Article 37 sub Article 3 says that, okay, that as I mentioned you, the losses, the pre-incorporation losses, the pre-commencement losses will not be allowed, and in case the exempted activities there in case of there are the two divisions. So X LLC have the division A and division B. The division B is doing the exempted activity and division A is doing a taxable activity. Then the set-off of loss is not allowed. My dear friend, I also mentioned you that first of all, you have to adjust the tax losses with the subsequent period income, and then only you can reminder. So you can see that it mentioned that the set-off of against the taxable income of that subsequent tax period must be. So the word must be is very, very important for all of us to learn, that it says that any tax loss carry forward to a subsequent period must be set off against the taxable income of that subsequent tax period. That's why I mentioned you that you have to adjust the 300,000 compulsorily before any remainder can be carry forward. And that's why we not claim 50%, we claim 75%, and that is the maximum amount which is allowed. So both sides, it's a minimum and maximum, both is being restricted as given in the Article 37. Now, my dear friend, if I just take you on the Article 38, which talks about the transfer of tax loss. As I mentioned you, that both should be a taxable person, both should be a resident person, and there should be a 75% plus ownership should be there. Then only the adjustment will be allowed. My dear friend, we also discussed about that A and B both should be not an exempted person, and they should not be falling under the qualifying free zone person, and both the financial years and other things should be same. Now, my dear friend, if I take you to the limitation, as I mentioned you that the limitation, if we talk about the limitation, says that the ownership which I mentioned in the presentation also should remain with the 50%. And another aspect which is there, that in case there is a change in the asset, change in the taxable person is getting changed, the assets and the activity should remain the same, even in case of a recognized stock exchange. My dear friend, there is another aspect related to the article 40, which talks about the tax group, which I will take you later on. Before that, I will take you some examples related to this Article 37 and Article 38. Now, my dear friend, the tax loss which we discussed, let us understand with the help of an example. Messrs. XYZ, as I given in the example, have the two business division. I believe it is visible and audible to everybody, Chirag ji.
Yes, sir.
Yeah. So, Chirag ji and Hari ji, that in case we are discussing about this tax loss, let us take this example. Messrs. XYZ have the two business division. One is the extractive business. You are aware it is an exempted activity, and the tax consultancy is a taxable activity. Now, I have given the profit and loss for the different financial year in this particular table. So 2022-23, they have the income of 600,000 and so. And so this is there. Now we have to understand that how the tax loss will be adjusted or carry forward for the financial years, year-to-year basis. Now, my dear friend, if I take you on the answer, as you are aware that the 22-23 is a year when the corporate tax was not introduced. So even if there is a loss in the consultancy, that will not be adjusted, or that will not matter to me at all. Similarly, in the 23-24, the corporate tax was introduced, but there is no loss between the two divisions. So there will not be any requirement of the set off or the carry forward as well. Now come to the interesting part of the 24-25, wherein, Hariji, we have a extractive business is having a surplus of 1 million, whereas for the tax consultancy, there is a loss of 400,000. Now, my dear friend, as you are aware, that this tax loss cannot be adjusted. The tax consultancy losses cannot be adjusted against the exempted activity, meaning thereby the entire loss of 400,000 need to be carried forward, because there is no positive income which is subject to corporate tax is there with the assessee. So again, I repeat, because the extractive business is an exempted activity, the loss from the tax consultancy cannot be adjusted against. So you can't say that, okay, I have a 600,000 net income to the authorities. No, it will not be a case. There will be a 1 million surplus from extractive business, and there will be a carry forward of loss of 400,000 from a tax consultancy. Now coming to the next year, 25-26. Again, now there is a vice versa, that the extractive business is having a loss of 100,000 and the tax consultancy is having a surplus of 400,000. Now, out of the 400,000, what I will do, that I can adjust the maximum 75% of the earlier loss, meaning thereby 300,000. So what I will do, I will adjust this 300,000, and my tax loss of 100,000 will still be carried forward to the next subsequent financial year. So what will happen, Hariji, that my taxable income for the purpose of tax to the government authorities will be only 100,000 for the 25-26 as well, on which I have to pay the corporate tax, which is applicable, whatever is applicable. Now, my dear friend, coming to the next year, 26-27, I have an income of 400,000 from exempted activity and 400,000 from a taxable activity. So first, what I will do, I will adjust the remaining carry forward losses of 100,000 in from that, and finally I will pay the tax on the 300,000 income which relates to my tax consultancy. So this is the way that you have to adjust the, or you have to carry forward the loss or the set of the losses. Now take another example is there, which I just wish to, I mentioned you in my presentation, but again, I wish to draw your attention that I mentioned you that you have to adjust the 75%. Now in the question, if the XYZ Limited has the option to adjust, whether the XYZ Limited has the option to adjust only 200,000 in the 25-26 and rest in the 26-27, the answer is no. Because as per the provision of section 37 subsection 4, it says that the tax loss carry forward to a subsequent period must be set off against the taxable income of that subsequent period, and only the remainder can be carry forward. So what is allowed you? The law allowed you up to 75%, meaning thereby the maximum of the things which is allowed to you have to be adjusted in the subsequent financial year. You can't say that, okay, I will carry forward only half of that and I will take the set of half of that. That is not allowed. Now, my dear friend, coming to the next question. That
excuse me, Atulji, I think your camera is not visible.
Okay, but my this presentation is there, na?
Presentation is available,
no
but
problem.
you are not visible.
No problem, sir.
Okay.
Maybe some technical issue is there, as Simran mentioned, that maybe because of the technical reason it may happen. Now,
Okay.
Coming to the next question, that the XYZ is having the two business division. One is again taxable, one is again extractive business, and the another is that the tax consultancy. And now you have to understand that how the set off of the or the carry forward of the losses will be there. So the figure is given to you for 21 to 26. Now, my dear friend, let us understand that for the first year, since it is a pre-corporate tax era, so no adjustment is required, as well as for 22-23 as well. Now for the 23-24, what will happen that out of the 900,000 extractive business, which is the exempted business, we have a loss of 350,000 from the tax consultancy. As I mentioned you in the earlier example, thus both are not adjustable because one is exempted, one is taxable, not adjustable. But in the next year, both are. So what will happen? It will be a carry forward of 350,000 tax consultancy for the next financial, for the subsequent period. Now for the what will happen that for the 24-25, there will be a extractive business of 300,000 and the tax consultancy will have a 400,000 income. Now out of this 400,000 income, as I mentioned, that though there is a missing in the presentation, maybe because of some technical reason, that the out of this 400,000, again, the assessee will be able to adjust this 350,000 out of this 350,000, 300,000 from the tax consultancy as a carry forward loss, and the 50,000 they can carry forward. Similarly, as I explained you in the earlier example, for the next year also. Now, my dear friend, I am now taking you to the example where there will be a transfer of the tax loss. That is Article 38. Now I have the two examples for the transfer of the tax losses. Now in this case, Mr. X having the two companies, XYZ Limited and the ABC Limited, wherein he is having the 100% shareholding in both the companies. Now what will happen that in case of a XYZ Limited, there is a income in the different financial years. Likewise for the ABC as well. Now there is a case that the XYZ Limited transfer a tax loss of AED 100,000 to ABC in the year 25-26. now we have to calculate the tax loss which are adjusted and tax loss which are carry forward for both the companies. Now, as far as the XYZ is concerned, let us understand for the year 25-26, the tax loss which is accrued to the XYZ is 400,000. Now it transferred the 100,000 to the ABC Limited. So what will happen? The tax loss which is available for the carry forward by the XYZ is only 300,000 because they transferred 100,000 to the ABC Limited. So what will happen that out of the 2 lakhs rupees, 200,000 income of the next financial year, the subsequent tax period, that is 26-27, they will be able to adjust only the 75% of the same, that is of the 200,000, that is 150,000. 150,000 AED they can adjust in the 26-27, and rest of the amount they have to carry forward for the subsequent period, that is for the 27-28. I believe this is a clear example to all of you. Now I am coming to the ABC. ABC is having a tax loss received from XYZ for 25-26 is 100,000. What they can do, they can adjust because they have an income of 100,000 as well only, and entire amount is received as a loss from XYZ, but they are supposed to adjust only 75% of their income. So what will happen? They will be able to adjust only 75,000, and rest of the losses which are being received from XYZ, they will carry forward for the next financial year, the next subsequent financial year, that is 26-27, that is 25,000, which they will be able to adjust out of the 400,000 income of the 26-27. So there will not be any carry forward of losses required at the part of the ABC. So my dear friend, this is the way that our Chirag ji mentioned that when we discuss about the tax grouping or the transfer of the tax losses, that how you can have a better tax planning in case their X is having the ownership of both the companies, more than 75% of both the companies, then only this mechanism is available. As I mentioned you in my presentation, that there should be a ownership of more than 75% available to X for both the companies, that is XYZ and ABC, then only this kind of adjustment is available. Now, my dear friend, coming to the next example, that the X is having the incorporated the 2 companies. I believe that Now the X has incorporated the 2 companies XYZ and ABC, as I mentioned you in the earlier example, with the 100% shareholding, and these are the incomes available with the XYZ. Now the same question is there, that for the 25-26, the XYZ transferred a tax loss of this much. Then how the amount will be adjusted? Now, my dear friend, I just take you what will happen, my dear friend, that for the year 23-24, because both have the positive income, so there will not be any set off or carry forward of losses will be required. For the 24-25, so it's a more comprehensive example. For 24-25, Hariji, the XYZ will be having an income of rupees 500,000, whereas the ABC will be having a loss of 180,000. Now, what will happen? That they have to they decided to carry forward the entire amount because they are not giving a set off to each other. So the 180,000 they will be ABC will be carry forward. ABC will be doing a carry forward. So we are doing a calculation or computation only for the ABC. Now for the 25-26, the ABC is having a income of 200,000. Now out of this 200,000, they are allowed to adjust only up to 75%, meaning thereby 150,000 they can adjust, and the 30,000 rupees they have to carry forward. But they also received a loss from XYZ of 100,000. So what will happen, Hariji? That the carry forward of losses for ABC will be, rather than 30,000, it will be 130,000. 130,000 amount which they have to carry forward for the next subsequent, that is the next financial year. Now in the next financial year, what will happen? That they have a income of 200,000 ABC is having an income of 200,000 as a positive income. So what they will do, that they can adjust both, because they have a limit of up to 150,000 they can adjust. So first they will adjust for their amount, that is 30,000, and then they will adjust the tax loss which is getting transferred from XYZ of 100,000. So practically the entire amount can be adjusted by the ABC against their positive income, which is their 200,000 in the 26-27. So what this example is trying to give, that not only ABC will be able to adjust their own losses, carry forward losses in the subsequent period, but also if any losses is being received from the sister concern under the same ownership of Mr. X, where the ownership of X is more than 75% in these cases. So my dear friend, this was in relation to the set off or the carry forward of the losses or the transfer of the tax losses. Now here in this example, I just try to prepare a diagram wherein I'm trying to show you that Mr. X is having the different companies. He is having the XYZ Limited where his holding is 100%. Then he is having a company called ABC where the X is having a holding of 60% with a XYZ is 20%, meaning thereby Mr. X is having a holding of 80%, so which is more than the 75%. So meaning thereby, whenever there will be a loss of XYZ and the ABC, in case that can be transferred between the two entities. But when we talk about the ramen company, the X is having only the 60%, meaning thereby the ramen company, any loss cannot be transferred to ABC or XYZ vis-a-vis the shaman company, because the shaman company, though the X is having more than 75%, but that engaged in the extraction business, meaning thereby in the exempted business. So what will happen, that the ABC and XYZ will be able to set off their losses among each other. But what will happen with the ramen company, it will not be allowed, as a red arrows are, and likewise for the shaman company, the red arrows are there. So what I'm trying to convey you from this kind of illustration and the example and the diagram, that the two very, very important provision of set off and carry forward of losses vis-a-vis the transfer of the tax losses between the two sister concerns are something which we need to learn from this kind of example or the illustration. I believe this will help my colleagues to have the better understanding of the things which I try to share with you. I'm aware that I took a lot of time to explain a particular provision, but as I discussed with Haribhai, that my habit is to give a more and more case studies so that we can have a better understanding of the things as compared to we are just passing through the various provisions which are there. Now, my dear friend, coming to the tax group, I am aware that we have only 7 minutes time available to complete this particular deliberation, but I will not take the example, Haribhai, for the tax group, but just I share you the flow chart just to give a brief overview of the tax group to all colleagues. In the meantime, you may see that if there are the questions which you wish to dealt upon in the chat box which are available. Now, my dear friend, when we are talking about the tax group which are getting dealt by this Article 40 of this particular legislation, wherein there are the one parent company and the other subsidiaries. So there are the other companies, other small companies are there, which are getting clubbed for the purpose of the corporate tax, called as a tax group. Now, my dear friend, each of the company which is getting merged into the tax group will be called as a subsidiary company. So now who can get merged into this parent company, and what will be the ecosystem, how it will work? I'm just trying to explain you. Now, my dear friend, who can form a tax group? Number one, that if all the entities which are resident juridical person, then only they can form the tax group. If there is any company which belongs to a free zone company, then that cannot be the part of the tax group. Number one. Number two, that the parent company should own minimum 95% in the subsidiary with a direct or indirect. As I mentioned you, the X is carrying the capital in the ramen company or a or B, which I mentioned in the earlier slide. The parent company should have the holding of more than 95% in the subsidiary with a direct or indirect relationship. Or there should be a voting right available with the parent company for more than 95%, or the profit share is more than 95%. So what will happen that because of this situation, scenario, the Article 40 sub Article 1 says that if you are following all these points, then only the 5, for example, there are the 5 companies who wish to have a tax group. So how they will be able to allow in case they fulfill the minimum eligibility criteria, which I mentioned in the Article 40 sub 1, Article 41, that they are complying with the following requirement. Now, my dear friend, the another requirement as given in the Article 40 is that all the companies who are becoming the part of this tax group should be following the same financial year and the same accounting standards. It should not be a case that, okay, they have the different financial years or the different accounting standards they are following. Now, my dear friend, the another aspect that they are not exempted activity. So what should not be happen that, okay, if you are free zone or you are exempted, you are doing exempted activity, say for example, extractive business, then you cannot form part of the tax group. That is not allowed. But yes, there is an exception that in case you are a government entity, then you can also part of the tax group, even if you are doing a exempted activity. Now, my dear friend, if all these companies, say for example, there is a parent company and there are the 5 subsidiaries, they made an application to the authorities that, okay, we want to create a tax group. In that case, they will be called as a single taxable person. Now, my dear friend, what will happen if they are becoming a single taxable person? They will not only be jointly and severally liable unless approved otherwise. So what I'm saying that they will be jointly and severally liable. So each one of them will be liable for the various provisions of the act. But in case somebody apply that, okay, it will be only the parent company who will be liable for this all the different provisions, then the government authority may approve the same, then only it will be the parent company. Otherwise, everybody will be equally liable. And then they will be responsible for the corporate tax payment, the tax registration, return, and refunds vis-a-vis the withholding tax. So all the provisions will be applicable on the jointly and severally, but as a single taxable person. So this single taxable person will take the registration, will pay the tax, will file the registration, will file the returns and refund and withholding tax and so in case it is being approved by the authorities like this. Now, my dear friend, there are 3 aspects which is very, very important to learn by all of us. That say for example, there are the 5 subsidiary and 1 parent company. They created a group. Now the 7th company wish to join. Okay, or any out of the existing 6, one want to go back, one want to leave the tax group. In that case, they can take approval from the authorities, and whenever they will take the approval of the authority, that will be treated as applicable from the day 1 of the tax period. So whether it is a joining, it will be from 1st July. It will be a leaving, it will be applicable from the 1st of July. There will be a case that there will not be any tax group. Say for example, the ownership remained 90%. So what will happen? The entire tax group will practically collapse. So what will happen? There may be a situation that if 1 to 6 conditions are not being fulfilled, some of them start dealing in the exempted activity, or they are not following the same financial year, or the ownership rights reduced less than from 95%. In that case, the tax group will cease to exist. But the only point is that there may be a situation that the one holding company is taking over the holding company of the tax group. So for example, the X LLC was the holding company that has been acquired by the Y LLC. In that case, what will happen? The 5 subsidiary will remain the same. X will be getting replaced with the Y. In that case, the tax group will not cease to exist. That will continue as it was earlier. Now, my dear friend, coming to the last slide of my deliberation for the day, that as we discussed, that the tax group will be there will be a parent company, it will be a single taxable person, they will be jointly and severally liable. Now, what will happen? Once there will be a single taxable person, the single person taxable person has to consolidate the transaction as per the accounting standard, and they have to eliminate the cross transaction, meaning thereby if the transaction is there between, say for example, X LLC is a holding company which is now a single taxable person with the A, B, C, D, E, 5 subsidiaries are there. So if there are the transaction between A and B or B and X, so all those transactions will get eliminated because they will be giving one side, they will be giving an income, another side, they will be an expenditure. So all the cross transactions need to be eliminated, and then you have to do a consolidation unless somebody leaves the group within next 2 years. So that is something which we will try to explain in an example in the times to come. Now, as I mentioned you, they will be responsible for the various tax compliances. Now, my dear friend, there are certain set of the rules which is there. Number one, that in case A, B, C, D, E, who are joining as a subsidiary to X LLC, if there is an unutilized losses of A, which is a subsidiary, then that loss of the subsidiary of A can be adjusted with the profit of the entire group. So that is permitted, that A will come with the losses and then that will be set off with the group profit. But the vice versa is not available. If the group losses are there, then if the new subsidiary is joining and having a profit, then that loss cannot be adjusted with the profit of the new subsidiary. The third one, if any subsidiary is leaving, okay, with the losses, so what will happen? Say for example, the C LLC is having a losses and now they are moving out of the group. So what will happen? That the losses of the subsidiary will remain with the group only. But as I mentioned you, that the subsidiary will join with the losses. Say for example, the subsidiary, when the C LLC joined, there was a loss of 50,000. Now when they are leaving, the loss is, say for example, the 30,000, which is unadjusted. So that 30,000 C has to take along with him. So that will not remain with the group because the subsidiary came with the loss, which was not get adjusted. In that case, that subsidiary is, if going, that will go with the loss only. Now, my dear friend, as I mentioned you, that if the Y LLC will take over the X LLC, that is the parent company is being taken over by somebody else, then whatever the losses are there, that will remain with the parent company. But in case the tax group is now no more, in that case, the losses will not be adjusted with these subsidiaries except of their unadjusted losses. So as I mentioned you, the 30,000 loss, the subsidiary has to bear, but all the other losses will not be adjusted against the subsidiary. It will be with the parent company only. So my dear friend, these were the aspects which I tried to explain you within the limited time. The law which is there for Article 40 carries in the various slides, but as the times is not available, so I'm just signing off with the thanks to my colleague who given me this opportunity, and I try to justify the time with the few topics which is allotted to me. Thank you very much, Hariji, and thank you, Chirag ji, Madam Simran ji, and the team Taxo.
Thank you, sir.
Thank you so much. And with this, we come to the end of the presentations that all the wonderful speakers had to give us insights on. And now it's time for us to take some live questions that are being posted in the Q&A panel. So I will just say a question and whoever would want to answer that.
Yes, so first question was raised by, I think, Manish, that sales commission paid to freelancer, will it be considered as a deductible expense? So again, there is no yes or no. We have to see the business practice. What is the business practice industry norms? Number one. Number two, if any agreement is being signed. Then number three, the underlying trade, whether it's a genuine business transaction or not. So we have to see all those circumstances, and then only we can arrive at whether it's allowed or not. In the similar way, he asked another question whether if the same is paid to employee. So might be if it's a real estate company, so this is normal practice in UAE for the real estate company to pay sales commission to agents. So this may be allowed, subject to again the same is mentioned in the offer letter. How much is the rate? Whether it's more than market or not.
I have a question from Dipanshu. If you allow me, Hariji, I should take the question.
Yeah, please.
Dipanshu ji, I have a question that I have a carry forward losses in the next year also I have a loss again. So in the third year I have a profit. Then I need to set off losses as per the FIFO method. As such, there is no requirement in the law, Dipanshu ji, that you have to adjust the loss as per the FIFO method. Because say for example, you have a loss of 50,000 dirham in the first year and 30,000 dirham in the second year. So the total loss is 80,000. You can adjust as per your own wish. though if you are using the FIFO method, that also is a perfect occasion. So as such, there is no requirement in the law that you have to do as per the FIFO method. The another question is there from Ajuma Hussain. If the available income in the current year is more than the loss, okay, from previous year, can we set off loss fully in 1 year? As I mentioned you, Ajuma ji, that the maximum loss which you can adjust with the current year income is 75%. So if you have, say for example, income of 1,100,000, because I speak in India a lot of the 1 lakh and all these things are used to come from my mouth. So if it is the income is 100,000 and you have a loss of 80,000, then you can adjust up to maximum of 75,000 in that year. So you can't adjust all the 80,000. As I explained you, 5,000 you have to carry forward for the next financial year or the subsequent year. So the Vishal Lodha ji is having a question. So the taxable income will be 5,500,000 minus 375, 80, 125 will be taxable income, of which 75% would be allowed. Vishal ji, I am not able to take you the question because you are talking about the presentation from the presentation. But I can do, I can go back to the presentation from my level only rather than showing to you. And I believe that I will be able to answer you what you are talking about. Just a second. You are talking from the question number. Okay, I am not able to take the questions from you are talking about. Vishal ji, carry forward losses will be applied after taking exemption of AD 375. Oh, you are saying this. So if the business has profit of 500,000 and carry forward losses of 300,000, then how the amount will be adjusted? So as I mentioned you that please try to understand, even in the income tax of in India or any other jurisdiction, first you set off the losses and then you calculate your income subject to the tax. So first you have to adjust the loss and then you have to see the threshold limit which we are talking about. So if the income will come down to the threshold limit, then there will not be any tax. It will not be a case that, okay, first you will pay the tax and then you will adjust. Then what is the purpose of setting off of the losses? So now I got your question, but you are trying to say, Vishalji. So I believe that I answered your question. Another question is there from Raghav Parbu. Yeah, taxable income is after deducting the basic exemption limit of 375. Yeah, answer is yes, Vishalji. Raghav is saying, can the transfer of loss be between group companies be decided by the transferor, or is there is cap on transferor amount? There is no cap, Raghavji, as such, unless with this condition that you have a more than 75% or this ownership available in both the entities, you can adjust the any amount. So there is no cap as such of the transfer amount which we are talking about. Now the other questions relates to you, Hariji and Raghavji.
Yeah. So another question was change of financial year. So as we already discussed that GAR, General Anti-Abuse Rule, Article 50 is already kicked in. So unless there is absolute necessity and reason, we cannot change the financial year just to prolong or take benefit of the period. So it's advisable not to change unless until there is some justification is there. Second, another question is raised by Saeed Arif. Can you elaborate aspects of free zone company and license company? So sorry, the question is not clear. A license company means a mainland company or what? So can you please elaborate so we can take up your question? Moving on, we have a question by Richa. If a free zone company is a flexi-desk office employing employees on payroll, will it be enough substance as per the UAE tax law, assuming all other conditions are met? My question is, conducting business to flexi-desk, can this be considered as a place of business to do substance? Yeah, so over here again, free zone company, assume you want to take the benefit of qualified free zone having qualifying income. So yes, the law uses the term adequate substance, but the term is not clearly defined. Maybe we can wait for the cabinet decision to have better clarity. Number one. Number two, as you mentioned that you have employees on the payroll. So if you have employees on the payroll, then where they are sitting? Since you are flexible, so are they sitting in the mainland? Then it would be a tricky situation. It's better to have a physical office, and your employees should be staying in that physical office to prove substance in the company, and then we can claim the benefit of qualifying free zone.
Yeah, I think one of the first question asked by Mr. Benjamin, he is asking that partner salaries and expenses will be allowed as a deduction or not. See, partner salaries and expenses, again, I mean, we have to wait and watch, but this will be part of the transfer pricing documentation. You need to substantiate by having proper documentation that the salary is reasonable given the qualification and experience of the partner. So transfer pricing documentation will be required in that case. Then there is one more question on additional salaries allowances paid to staff in addition to WPS. So if you are paying any other salary or allowances and that not through the wage protection system, then I mean, if you are able to prove, it should be allowed, technically speaking, given the employee's technical qualification and experience. But yes, we can wait for the cabinet decision further on these kind of items. And I think there are a few questions which were already answered while we were doing the presentation. Then there is one very important for a free zone person, whether is it mandatory to have substance in free zone or substance on the mainland through outsourcing will suffice. Nishant, this question is, I think if you are in the free zone, then you need to have the substance in the free zone. You cannot outsource it to mainland and then you create the free zone in the mainland rather than in the free zone. So for free zone persons, they have to create a economic substance in the free zone. Otherwise, if you are having a substance in the mainland, then what will happen? Authorities will consider free zone company as a mainland company, and free zone company has to pay 9% tax on the entire profit. So it is better to have your substance in the free zone rather than in the mainland. Then another question he had asked for, offshore and onshore companies are same. So offshore companies require substance. This one offshore companies, still we have to wait for the clarification, because generally offshore companies are not having any substance in the country. They are not having their they cannot have any visa, they cannot have any employees. So how do they create substance? But Ras Al Khaimah economic zone, they have come up with a unique feature whereby offshore company can have a free zone company as a shareholder, and that free zone company can have an economic substance in the free zone.
मनोज जी आप स्पीकर म्यूट कर दीजिएगा.
And that free zone company, as a subsidiary company of the offshore company, so they can have an economic substance in the free zone. Then I think substance issue will be resolved, particularly in case of Ras Al Khaimah economic zone. But I am not very clear on the Jabja free zone how it will be handled. So we have to wait for the further clarification through the cabinet decision from FTA.
One question is by Prakash. He has asked, interest charged by shareholder, is it allowed as an expense? So again, we have to see transfer pricing, whether the transaction is arm's length or not. Then only we can arrive at that whether it is deductible or not. Unfortunately, we cannot have yes or no answer over here.
Yeah. And there is one question from Prajesh. He is asking, is there any time frame allowed to write off bad debts when we recognize? As of now, I mean, there is no time frame given in the corporate tax law, but I hope that the cabinet decision will clarify it further in detail. I think we have taken enough questions. Chirag, is there any other question you want to take it up?
Let me check. I think Vishalji's question has already been taken up. The taxable income is after deducting the basic exemption limit of 375. So Vishalji, first we have to see the, your net profit. Suppose the net profit is 400,000, which is the taxable, it will become taxable income. And from this, you will get the basic exemption of 375, and more above income more than 375, you will pay tax. So, like in this example, the profit is 400,000. So, basic exemption will get 375,000 there. So, over and above this 25,000, on this, you will pay 9% tax.
Yeah. Then Hemant Mittal is asking one question. Single director is single employee in a free zone company. Still, director's fees limit be applied. So this director's fees limit, what I have given you is applicable for the public joint stock company. But yes, I think in the cabinet decision, they might come up with a threshold for which we have to wait and watch.
We can take one last question from Ajuma. She has asked that free zone company and mainland company already registered for VAT as a group. Can still they continue for group or VAT under corporate tax? So we already discussed that corporate tax, VAT grouping, and the VAT grouping as per UAE VAT law both have separate terms and conditions. So we have to see if you are able to satisfy the conditions as per the corporate tax, then we can have the same group. Otherwise, we have to see if what are the conditions, then only you can form the group. So the answer is no, we cannot have the same group if you are not able to satisfy the conditions, and we have to take a separate registration under the corporate tax.
Yeah. I think, Chirag, now we are overshooting the time. Maybe rest of the questions we can take it offline and reply to the participants. I think now I will end up the conference. I mean, by you guys are aware that there is a saying that nothing is certain except death and taxes. Who can postpone the death? Nobody can. But at least doctor, maybe, I mean, while you are sick, can reduce the pain. Now, who can postpone the tax? It is coming, sir. 1st of June 2023, it is coming. But yes, being a chartered accountant, we can help you to reduce the tax liability by having the proper tax planning. Yes, within the framework of the corporate tax law. So that's it from our side. And I think now we can end the session, if all agrees.
Thank you very much.
Thank you. Thank you very much and have a nice day.